S&P 500 futures are they're currently up nearly a full percent in the pre-market, trading at 7,485.25. Dow futures are also catching a bid, gaining 0.6%.
Right, and the overnight catalyst driving all that volume is massive.
Yeah.
We're looking at a historic U.S. and Iran interim peace agreement that officially ends a 100-day conflict.
Yeah, which instantly cratered WTI crude oil. I mean, it's down 2.5%, sitting right at $74.85 a barrel.
And by all traditional market logic, those metrics should be setting us up for just a euphoric, multi-week gap-and-go bull run.
But they aren't.
No, they absolutely are not. Instead, the smartest institutional capital on Wall Street is quietly running for the exits and preparing for a severe drawdown.
Which brings us directly to our mission for today's deep dives. It is Thursday, June 18th, 2026. The bell has not rung yet. We are pulling our data directly from today's morning strategy brief, from bulls, bears, and the bell.
Because we really need to dissect these deeply conflicting forces ripping through the pre-market session.
Exactly. You have this massive geopolitical relief rally, violently colliding with, well, a really hawkish reality check from the Federal Reserve.
Yeah, so our goal today is to map out those underlying mechanics, define the critical support levels, the lines in the sand, and figure out what is genuinely moving the money.
Right, so you don't get trapped trading a headline that is basically just masking a structural shift.
I mean, the danger this morning is totally the optical illusion created by the news cycle. The brief calls it the pain trade.
The pain trade, yeah.
Yeah.
Let's pull apart that headline first, because that drop in WTI to 74.85, that acts as an instantaneous global tax cut.
Oh, without a doubt.
Every logistics company, every cargo ship, every manufacturing plant suddenly sees their input costs just plummet.
Right, and historically, when energy prices drop that aggressively, it strips out the core inflation fears.
Yeah, the market assumes inflation is dead,
Yeah.
and the natural conclusion is that central banks are going to start cutting interest rates to stimulate growth.
Which is exactly what the pre-market algorithmic buying is assuming right now. But the foundation of that bullish thesis was structurally dismantled yesterday afternoon.
By the Fed. The timing of the Fed meeting just creates a brutal headwind here. Yesterday, the newly appointed Fed chair, Kevin Warsh, held his debut policy meeting.
And he held the baseline rate steady, right?
Yes, steady at 3.50 to 3.75%, which the street had already priced in. But the shot came from the updated dot plot.
Right, the matrix showing where the governors see rates going.
Exactly. Warsh bumps the median projection up to 3.8%. He's explicitly telegraphing a potential rate hike later this year, likely targeting the September meeting.
Which is wild because the market spent the last 6 months positioning for aggressive rate cuts. Warsh just completely inverted that timeline.
He looked at the underlying data and effectively told Wall Street that liquidity is going to get tighter, not looser.
So how does that policy shift actually stop this peace deal rally? You have to look at the macro overlay from the brief.
Yeah, the pressure is coming from two specific metrics. The 10-year Treasury yield is hovering at a restrictive 4.45%, and the U.S. dollar index, the DXY, it remains aggressively strong at 100.35.
And with the 10-year yield up at 4.45%, that acts like financial gravity on tech valuations.
Because if an institution can secure a guaranteed, risk-free 4.5% return in government bonds, they have to heavily discount a software company's promised earnings for, the year 2030.
That's exactly it. The institutional flow reflects that multiple compression perfectly. Valuing high-duration growth stocks relies on discounted cash flow models.
Right.
So when the risk-free rate rises, the present value of those future tech profits shrinks dramatically. Why expose billions to tech volatility when you can just lock in 4.5% holding duration paper?
And that strong dollar at 100.35 compounds the issue, right?
Right.
Mega-cap tech companies generate massive revenue overseas.
Yeah, and when the dollar is that strong, foreign revenue translates back into fewer dollars on the balance sheet. It's a direct hit to their earnings per share.
The reaction in the overnight session just proves the severity of that multiple compression. I mean, following Warsh's press conference, Microsoft dropped 3.8%.
Amazon shed 3.5%.
Yeah, and NVIDIA slipped 1.3%. The market is aggressively repricing future earnings based on this heavier rate environment.
Which sets the stage for the pain trade trap that is unfolding literally as we speak. We've got a fundamental disconnect between institutional strategy and retail sentiment.
I want to make sure the mechanics of this trap are crystal clear for you. The pain trade isn't just some theoretical concept, it's a wealth transfer.
A brutal one.
Retail traders are waking up today, looking at their screens, seeing the peace deal and the drop in oil. They're going to jump in at the 9:30 a.m. implied open, buying the dip on Apple and Microsoft, assuming they're getting a discount before a rally.
But they are stepping directly in front of an institutional freight train. By 3:00 p.m. today, the institutional managers who do not care about the peace deal.
Because they're strictly trading off the 10-year yield constraints.
Exactly. They are going to use that retail buying volume as exit liquidity. The smart money is quietly rotating out of high multiple long duration tech.
And moving capital into defensive sectors, value stocks, and cash equivalents. Retail is buying the headline, but institutions are selling the yield curve.
But there is a glaring anomaly in today's pre-market sector rotation data.
Yeah, I'm looking at the hardware and semiconductor groupings, and they are completely defying that financial gravity. I mean, they're the strongest pre-market movers across the board.
Right, because the separation between software and physical hardware is the defining theme of the quarter.
Software relies on cheap capital and distant earnings.
But domestic manufacturing and semiconductor infrastructure, they're experiencing a structural regime shift. The geopolitical mandate to build physical tech infrastructure on domestic soil is just totally overpowering the interest rate fears.
And that mandate brings us to the most significant corporate catalyst of the morning. Overnight, President Trump announced that Apple has officially partnered with Intel for domestic chip design and manufacturing.
Yeah, they are transitioning critical silicon production to Intel's cutting-edge 18A process node.
And to grasp the magnitude of this shift, you really have to look at the bottlenecks plaguing the current global supply chain.
For over a decade, Apple has relied almost exclusively on TSMC Taiwan Semiconductor to produce its most advanced chips.
But TSMC is running into severe physical constraints, specifically regarding advanced packaging like their chip-on-wafer-on-substrate or CoWoS technology.
Yeah, they literally cannot package the silicon fast enough to meet the surging global demand for AI and consumer tech.
And that's completely setting aside the geopolitical risk of concentrating the world's chip manufacturing on a single island.
Exactly. So Intel's 18A node offers this domestic escape route.
And from an engineering standpoint, the 18A process is a massive architectural leap. It utilizes gate-all-around transistors and introduces backside power delivery.
Meaning the power routes underneath the transistor rather than through the top signal layers, right?
Yeah, exactly. It solves critical power leakage issues, which is precisely what Apple needs to maintain battery life on highly complex mobile chips.
And securing Apple as a cornerstone client just validates Intel's multi-billion-dollar pivot to become a premier domestic foundry. The market is aggressively pricing in that validation today.
Intel is skyrocketing over 9% in the pre-market. It's currently trading near $130.95.
The brief sets a clear bull target of $135 to $140, assuming the pre-market volume sustains through the opening bell.
But the defined line in the sand, the bear case, sits at 120. If broader macro fears drag the indices down, Intel has firm technical support at that 120 level.
Apple is also catching a bid, ticking up roughly 1% on the de-risking of their supply chain.
But this hardware rotation extends beyond just the foundry level, doesn't it?
Oh, absolutely. The raw materials required to power these advanced systems are experiencing their own supply shocks, and it's severely impacting corporate margins.
Which leads directly to the secondary catalyst from Apple. CEO Tim Cook publicly warned this morning that memory chip costs have reached, quote, unsustainable levels.
The terminology there is crucial. Prices aren't just high, they're totally disconnected from traditional hardware cycles.
The demand for massive AI server clusters has created a black hole for high bandwidth memory, or HBM.
And HBM isn't your standard RAM. It involves vertically stacking memory chips and connecting them directly to the GPU.
Yeah, the manufacturing process is incredibly complex, yields are historically low, and the AI hyperscalers are basically buying absolutely every single unit that rolls off the assembly line.
So the memory suppliers have achieved unchecked pricing power. They are dictating the terms because the AI infrastructure companies have literally no choice but to pay the premium.
The analysts are rapidly adjusting their models to account for this leverage too. Citi analyst Atif Malik just issued a massive target upgrade for Micron ahead of their June 24th earnings call.
Yeah, he raised his price target from $840 to an unprecedented $1,200 a share.
So instead of betting on which AI software startup will strike gold, the institutional capital is buying the hardware companies manufacturing the pickaxes.
Right. The foundries and the memory makers hold all the leverage. They are aggressively raising the rent on the entire tech ecosystem.
And if the momentum holds into their earnings print next week, Micron could initiate a gap-and-go sequence directly toward that 1,200 level.
But, similar to Intel, if the 10-year yield spikes and the broader market sells off, Micron risks breaking its trend line and testing its previous consolidation floor at 840.
The overarching narrative here is that physical infrastructure is the ultimate bottleneck.
Totally. If top-tier foundries like Intel and TSMC are monopolized by megacaps like Apple and Nvidia, and memory prices are just spiraling out of control,
The smaller players are being forced to execute radical strategies to secure their own AI compute power.
which provides the perfect transition to the most bizarre pre-market gapper we're tracking today.
Oh man, yeah. Rumble. Primarily known as an alternative video hosting platform. But today, it's currently up a staggering 17% in the pre-market, trading at $8.55.
On the surface, a video platform surging on a day when tech is supposedly rotating downward makes zero sense.
None at all. Until you dissect their SEC filings. It reveals a complete transformation of their business model.
Rumble just closed a major acquisition of Northern Data AG, and as of this morning, they're rebranding the entire entity as Rum Group Inc.
They're executing a hard pivot into cloud computing. They're launching Quake AI, an enterprise infrastructure business powered by a cluster of 22,000 NVIDIA GPUs.
To put that hardware into perspective, a single top-tier NVIDIA GPU costs tens of thousands of dollars. Stringing 22,000 of them together creates a sovereign-level supercomputer.
The capital expenditure required for that kind of hardware is just astronomical.
And they bypassed the traditional capital markets to fund it. The filings indicate they secured the hardware through a strategic financial partnership with Tether, the stablecoin issuer.
Wow, so it's a direct convergence of crypto liquidity funding physical AI infrastructure.
But the big question is, why Rumble? Why does a video platform suddenly have the capability to run a sovereign-level AI cloud?
It comes down to physical real estate and power grids. Streaming high-definition video globally requires massive, liquid-cooled data centers with immense power contracts already secured.
Right, and Rumble already owns that underlying infrastructure.
Yeah, retrofitting an existing power-dense data center from video transcoding into AI model training is significantly faster and more efficient than trying to build a new AI data center from scratch.
Not to mention navigating zoning laws and waiting 3 years for the local utility to connect the power.
The infrastructure advantage is so profound that Northern Data just upgraded its full-year revenue guidance by 30%.
But a 17% pre-market jump on a 30% revenue upgrade creates a highly volatile setup for the opening bell. The brief maps out the risk-to-reward ratios pretty clearly.
Yet the pure momentum play, driven by the massive AI hardware volume, could push the stock toward the bull target of $9.75 to $10.
But the risk lies entirely in the valuation multiple. Rumble is currently trading at a premium price-to-sales valuation of over 17.
Paying 17 times revenue for a company undergoing a massive operational pivot is incredibly expensive.
Very. If early buyers decide to lock in their overnight gains, the sell news profit-taking could be aggressive. If it loses that momentum, the stock has a long way to fall before it hits its consolidation support floor down at $7.
So synthesizing all of this data for the trading day ahead, we are essentially dealing with two entirely divergent markets operating simultaneously.
Yeah, on one side, you have a massive geopolitical relief rally trying to fight its way uphill against the severe financial gravity of a hawkish Federal Reserve.
A strong dollar and a 4.45% 10-year yield.
And then, completely isolated from that macroeconomic pressure, you have the domestic semiconductor and AI infrastructure sectors generating their own explosive momentum.
Driven by unchecked pricing power, supply chain bottlenecks, and this frantic rush to secure physical hardware.
True financial literacy in a tape like this requires looking past the prevailing narrative. A peace deal is excellent news for the global economy, but it does not supersede the mathematics of the bond market.
If you trade the geopolitical headline today, you risk providing exit liquidity for the institutions executing the pain trade. You really need to keep your focus on the yield curve and the physical supply chains.
Because the data dictates the reality. The cost of building and powering the future is shifting violently.
And that data points toward a profound underlying theme we're going to leave you to consider today. We are watching Apple transition its most advanced manufacturing back to U.S. soil.
We're watching AI compute power become localized, hoarded in retrofitted data centers, and driving memory prices to unsustainable premiums.
We are witnessing the rapid deglobalization of technology. For the last 20 years, the devices we use every day became exponentially faster and cheaper because corporations optimized for the cheapest global labor and materials.
But now the entire industry is pulling that supply chain back home, and they're paying an immense premium to secure it.
If the hardware foundries and the memory suppliers continue to raise the rent, Eventually, that cost gets passed down the line.
It has to.
So how will this rapid shift toward localized, premium-priced manufacturing fundamentally alter the cost of the everyday electronics we rely on?
Are we crossing the threshold into an era where our essential technology no longer gets cheaper but becomes permanently more expensive?
The peace deal might dominate the morning chyrons, but the structural cost of doing business has permanently shifted. Watch the implied open, respect the levels, and we will see you on the next deep dive.